Welcome back, friends. I am joined today by Casey Oiness and Colin Tipp with Morgtgage, and we're going to talk about new mortgage rules and updates for 2025. So, Casey and Colin, let's put our heads together and talk about what the biggest rule changes are this year or what people need to know this year, starting with the one thing that changes every year, the loan limits.
Loan limits, yes. Every year they're increasing. For conventional, they went up to 806,500. So for a conforming loan, and you can put as little down as 3% there, which is pretty awesome.
Pretty good price point for around here.
In our market, King, Pierce, Snohomish County, and other major markets across the country, there is also what's called a high balance conforming loan limit. And in our three major counties, that goes up to $1,037,300. So, and at that loan limit, you've got to put a minimum of 5% down. But in some areas, you could do FHA with as little down as 3.5%. So again, you could buy like over $1 million home. That's awesome with 3.5% down. Pretty incredible.
And this is King, Snohomish, and Pierce, correct?
Correct.
And if you go outside of those, it's going to be different.
Slightly different.
A little bit lower.
Yeah.
Yeah. Some areas have lower limits. Some states and areas out there have higher lending limits. So
cool.
Specifically for FHA too. So like Thurston County, Kitsap County, some of those outer markets.
Yeah, that makes sense. And then are there any new down payment assistance programs or updates to the ones that we should know about?
Bill's got a pretty cool program. It's our 1% down program. So that means the borrower can put as little down as it's a 3% down conventional program. The borrower puts down 1%, and then Guild gives a 2% credit for the down payment for the borrower. So a total of 3% for them.
Wow, that's pretty fantastic.
Yeah. So we have that one. And then, of course, we have, the home advantage options and we use those all the time as well. We get our down payments covered by Washington State and then, relieving the client of having to bring all that to the table.
Yeah. And Guild is one of the top state down payment assistance programs, or the top in the state, aren't you guys?
Yeah. And actually we've been around for 65 years and we're one of like the leading mortgage companies when it comes to first-time home buyers. That's kind of how they built their business, was helping first-time home buyers. So
nice. Yeah, that's awesome. What about credit score requirements? Anything that's changed this year or that you want to point out?
It seems like certain programs I've been noticing have been able to get a little lower approvals with lower FICOs. We just did one at a 565 with FHA. I think you can get down to approximately like
540.
So there's other complicated factors. So you would essentially, if your score was that low, I think you would have to bring just a slightly larger down payment than 3.5%. And that kind of pushes through to approval sometimes. So
nice. Yeah, I think that's important for people to know, especially around here with rents going up so high, that you don't have to feel stuck just because your credit score is an 800.
No, we work with a lot of buyers to help them, go from, if they're on the brink of 500, 520 to get them to 560 and kind of work through that process with them too. So
nice.
Yeah. Last week I had a rapid rescore I did for a client. They were at 697. We rescored them. The score went up by 60 points within 4 days.
That's pretty impressive.
Yeah.
Yeah.
So you're basically credit repair guys too. I should put that out there. Yeah. And then is there anything new with regulations around self-employed people? How are they getting qualified now? Especially, I feel like we have a lot of folks like that in our area with contracting and stuff like that.
Yeah. So, typically when you're self-employed, you need a 2-year tax return history to qualify. But there are some circumstances where you can use 1 year of self-employed tax returns. If that wouldn't work for whatever reason, because a lot of self-employed people have lots of write-offs and they write off a lot of their income, then we can also look at bank statement programs where we get maybe a 12 or 24 month history of their bank statements, and we can look at the deposits that come into the bank statements versus what the withdrawals are, and we can come up with a calculation to have a certain amount of income. And so that's worked for a lot of like those newer self-employed clients.
Yeah. I definitely feel like we're seeing more of those right now.
Yeah. And then, go ahead.
And some of those self-employed people, they also might have just like sizable assets in their bank. And so there's some ways to come up with like it's called like an asset depletion program where you can use assets and extract some income from those assets to use from a qualifying standpoint. So
just average out the balance that they have over a certain amount of time, and then they get, a certain amount of monthly income they can use for approval.
That's pretty cool.
yeah, that's a pretty neat program. A lot of retired folks would, look into something like that if they don't have, normal income. They have a large retirement account. They can do something like that for qualification.
Nice. It's almost like RSUs kind of changing the asset into income.
Yep, exactly.
A little magic trick. Let's see, what else do we have? I guess looking forward for this year in the Seattle area, what are challenges? And let's get some interest rate predictions.
Yeah.
Everyone's favorite question, what are rates going to do? And then how does that translate into home buying around here?
Yeah. I think I've been saying this for too long, but interest rates are coming down.
Yeah. Yeah.
So I think the challenge is, though, home affordability, right? Home prices where they are in Seattle, they haven't really come down over the last, 5 years. So anything, they probably just continue to go up, or been stable. And with the rates where they are, that's been more of a challenge for buyers in this market. And I think we've seen a lot of people kind of sit on the sidelines waiting for rates to come down.
Yeah.
But now all of a sudden you're seeing those buyers who've been on the sidelines coming back into the market saying, I want to buy, and rates are what they are, and eventually they'll come down. So that saying of, marry the home, date the rates, like that's probably a good logic. But for what we see and what we've always seen is the spring market's always the hot market, right? I call it the frenzy market. You got buyers on the sidelines. They've been waiting during the slower period of the year, Christmas and the holidays, and they come out of the holidays with a New Year resolution to buy a home.
There they all are.
And we don't have the inventory yet, so homes are coming on. But I recommend all clients right now, hey, buy as soon as you can right now while rates are higher, because when rates come down, more of those buyers are going to jump in the market. And as more buyers in the market with the same inventory, it's just a supply and demand thing. So, get into the home that you really love, whatever that is. Don't worry. I mean, the rate's important, but that rate is probably like a 12-month rate plus or minus, right? So you'll be able to refinance it, and we'll help them through that process.
And they're hovering around 7% right now too, which is not historically a bad rate.
Plus or minus a little bit.
Yeah, it depends on the program and client and things like that. But yeah, less on certain clients for sure, and others have a little higher. I mean, with let's say you're a conventional client and you're in the 600s in your FICO, probably going to be not as good of an interest rate as if you were at an 800. So,
and I think another comment to that is that mortgage rates should have never got to 2, right? So
I think that's the thing that everybody forgets, is that was the outlier.
So when rates get 5%, that is where they should be hovering around.
It's on a terminal rate or something like that, where it should be.
Exactly. If they got into the high 4s, that would be incredible, right?
Yeah.
And then it'd be like, oh my God, we have these crazy low rates in the high 4s or low 5s. Right. You can just get into the low 6s, high 5s. You're going to get a huge swarm of buyers coming into the market that are going to be able to pull the trigger and be able to have a home that they feel like they can afford the payment on.
Yeah. And that caveat is, if you did buy at a higher interest rate and all those people come in buying homes, home prices go up, you grow your equity, you refinance, that's the perfect storm, right? So a lot of us were able to do that when it happened this last time. And hopefully, we get some softening in the next, year or two.
Yeah. And I think, especially now with prices kind of on the rise again, one thing that I watch out for my clients is getting rid of that mortgage insurance, getting there to 80% loan to value, because rarely in this market do people hit that by making payments. They hit it by the equity going up. Right. And I've had a few clients who within a year or two are suddenly, they put 5% down and now they're 80% LTV. And so they can lower their payment, without a decent amount by getting rid of that. And then a lot of times just refinancing even at that point. Yeah. So the other thing too that I think is important to note with waiting, I see this all the time with my clients where they want to wait and wait and wait. But this time of year, especially, real estate spring starts in January, not in April or whatever the seasonal spring is. Home prices go up typically around 15% a year in Seattle. This time of year, they go up about 20%, and then they typically fall in about 5% in the second half. But if you figure you're going up 15% over the course of, 6 or 7 months, that's almost 2% a month on $1 million home. Start adding that up. I mean, that's $20,000 a month you're losing by waiting.
Right.
That's a lot of money to be losing in your purchase power. And, if you wait 6 months, now you're just out of the spring anyways. and you've lost whatever that is, $120,000 on your purchase price, when you could be in the home you want, you could be making that money instead of the people that did buy.
And that difference between a rate of 7% and 5% is maybe 1 or 2 months of that appreciation that happens.
Exactly.
People get a tendency to maybe, trip over dollars to pick up pennies on the other side of things. So it's like, let's look at the bigger picture. What's the end goal? What you're going to accomplish now, 1 year down the road, 5 years down the road.
Yeah. Awesome. Well, thank you guys. We'll be back for another episode shortly, and I appreciate you guys coming.
Absolutely.
Yeah.